Hello, everyone. Chad Frantzen here, and welcome to the Kingdom Finance Show. Today, we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello, everyone. Chad Frantzen here. Welcome to the Kingdom Finance Show. Today, we're going to dig into an economic market update. We're here at the beginning of the second quarter of 2023, and we want to take time on today's shows just to take a reflective look back on what's happened in the first quarter. And we've seen a lot in the last month, in the last 3 months, both in the United States and globally. So we want to dig into that a little more. I'm going to be referencing some specific statistics and data. So we'll geek out a little bit there. But in all things, as we talk about here on the Kingdom Finance Show, what we're looking to glean from is a kingdom perspective on how to make sense of things that seem nonsensical. So we want to look for how do we make order out of chaos? How do we find opportunities where other people may find fear or greed or anxiety or just uncertainty on that. So again, we want to be as wise as serpents and as innocent as doves as we think about managing our resources, managing our businesses, and the gifts that God has given us. So let's jump in. Again, we want to take a kind of a pulse on what's been going on in the markets and the economy. You know, just in the last 4 to 6 weeks, we've seen a couple of huge bank collapses, reminiscent of 2008, 2009 in SVB Bank and Credit Suisse Bank. And so there's been a lot of fragility exposed in the banking sector, particularly in the regional banks. And we've also seen corporate bankruptcy. Those filings for the first 2 months of 2023, they have hit a 12-year high. So more corporate bankruptcy filings than anything we've seen in over a decade. One other thing we talk a lot in some of our workshops and shows about debt, and the debt to GDP ratio is higher than any time since World War II. So what that means is we have a significant, a highly elevated level of debt, whether it's government debt, consumer debt, as a percentage of the overall size of the economy. We've seen interest rates reach their highest level since 2007. So that is certainly meaningful. And we've also seen multiple countries, China and Russia, leading the charge on ditching the U.S. dollar, doing things with the Chinese yuan and non-U.S. currency, non-dollar denominated transactions. We're going to cover that in another show, but that is something that's been in the news. I want to make mention of that. And yet, with all these things, fairly negative things, we've also seen here in the last few weeks, President Trump, indictment, first U.S. president to face felony criminal charges. Not going to focus on that, but want to recognize that there is a lot of craziness going on politically, geopolitically, and in the economy and the financial markets right now. Now, all that to say, those things are factual, data-driven, and yet when we look through the first quarter of 2023, the markets, and by markets I'm speaking broadly at the stock and bond markets in the U.S. and globally, they were up. And in fact, if you looked at the S&P 500, which is the 500 largest traded public companies in the U.S., that index, which is the largest barometer for the economy, in light of everything I've just told you here, as we've started the show, the S&P was up 7.48%, so almost 7.5% in the first quarter. So many investors, I think, are feeling good. They're looking at their 401ks or their brokerage accounts in what we call traditional assets, brokerage assets, and they're feeling pretty good as they look at those returns. We also saw large cap growth companies, particularly technology companies, overall as a sector was up over 14% in the first quarter. And this extended globally. We saw internationally developed public companies up over 8.5% for the first quarter. So again, the markets do not always act rationally. And so a lot of the data points that I've shared with you here and ones that you are familiar with interest rates going up, high inflation, corporate bankruptcy, really high debt rates, as well as what's going on with the U.S. dollar. And yet the major indices in the markets are up and up meaningfully for the first quarter. So let's dig into that a little more. My opinion is that there's a major disconnect in the markets right now. And I want to go through kind of three main points of why I think that is. And again, I want to educate you so that you can become a well educated, but maybe the better word is empowered investor when you think about stewarding resources with a biblical perspective in light of what's going on in the world. So first of all, why I think there's a major disconnect in the markets with what's going on in the economy and going on geopolitically around the world is one, investors think that the banking crisis was an isolated event and that it is done with. It's old news. And I don't think that's going to be how history sees this. I've got a chart here. I recorded another episode on what's wrong with banks, what's going on with banks, and I picked up a chart after I'd recorded that, which showed all the top U.S. banks and the percentage of those banks that have uninsured deposits. And of course, Silicon Valley Bank would be right there, number one. They had like 93% of their deposits were uninsured. But it's quite a who's list. There's big names on there that you would recognize. JP Morgan Chase is on there, as well as others, Goldman Sachs, Bank of America. But anyway, I didn't share these stats on that episode. But if you want to get a copy of this, it's a really interesting graph that shows these top companies. And a lot of people ask us, well, which bank should I work with for my personal needs, my business needs, whether you're a small business owner or you work for a major corporation. And happy to provide you this list. Just reach out to us at wealthbuilders.net and contact us, and I'll be happy to send this to you. But very enlightening to see what a lot of these banks, the exposure they have to what we call uninsured deposits. So a little bit of an aside, but again, the number one reason why I think investors have this disconnect is most investors, and I'm talking about individuals, but I'm really talking about institutions. So the big money investors, a lot of them, Wall Street based and otherwise, think that this was an isolated incident. Now, the Wall Street Journal came out with a report here in the last month that cited that there were close to 200 regional banks that had similar problems, which is really what this chart that I found it talks about. So there's definitely, I think, more systemic risk than what we realize. Again, I cover a lot of this in my other show on that, but I need to mention that because part of the reason why I think stocks are up significantly, bonds are doing well, real estate is holding its course is a lot of investors think that the banking crisis is kind of over and done with. Now, let me talk about another reason why I believe that the banking crisis still has more, there's more story there that's going to happen. We've talked about in the past what we call the yield curve, and the yield curve is currently inverted. And 100% of the time, the yield curve has accurately predicted every recession in the United States. I think the last 10 or 12 recessions. Now, I'm not going to teach on that in this show. I do that in some other places. But what you need to understand is banks, what banks want to do is they want to borrow money at a interest rate, short-term money at a low interest rate, and then they turn around and lend that money out to consumers, small businesses, big businesses at a higher interest rate, right? So Pretty basic business model. Nothing illegal with that. It's right. I mean, that's how the banking system works, right? So they borrow short-term money at, let's say, 2%, 3%, and they in turn lend it out through their products, through their banking products to consumers and businesses at a higher interest rate. So let's say, 4 to 5%. And that's where they make a profit. However, when the yield curve is inverted, what that means is that short-term money costs more than long-term money. So the math doesn't work, even if you're a fifth grader. So banks, if they go to borrow short-term money, they may be borrowing at, and I'm using arbitrary numbers here, banks may borrow at 4%, but they can only lend it out long-term at 3%, or something to that effect, just so you get the illustration. So the numbers, because the yield curve is inverted, which means interest rates short-term are higher and interest rates long-term are lower. And banks, that is a major source of profit center for banks. So I think what we will see is that I expect reduced lending by banks, regional and the big banks, because of where interest rates are. And I'm going to talk a little more about that. So we would refer to that as a credit contraction. So the economy works on the supply of money, the velocity of money, consumer spending. And so I do believe my point number one here is investors think the banking crisis is over, and that's why we're seeing stocks and bonds do really well. If banks stop lending, if they reduce their lending, that is going to lead to a recessionary environment. Now, remember that 2/3 of the economy is consumer spending, and a large part of the economy is small business, right? I mean, there's way more small businesses, mom and pop, privately owned companies, than there are publicly traded corporations like any of the ones that that you see on TV. So these are the real drivers of the economy. One report I read said from an analyst said that if banks truly do have to contract their lending services because of where interest rates are, that would be the equivalent of the Federal Reserve raising interest rates another 0.5 percentage point, or what we call 50 basis points. So what that tells us as business owners, investors, stewards of resources is that will have a major impact on the economy, right down to everyone across the United States, tax-paying working citizens. So I think there's more to come with banks, and I think that is part of why there's this disconnect in the markets. Now, one other point I want to make on that is on the real estate front. Since the pandemic, a lot of people work from home. We've got, the Zoom and Teams and all the video meetings. The office real estate market is about a $6 trillion market. Now that's trillion, not billion. So, and then we're talking in the United States here. So there's a brewing problem happening with office real estate. Now, some corporations and many people are going back to work, but it's not to the level pre-pandemic. One study we read showed that about 65 to 70% is the occupancy rate at office commercial real estate. Now, a significant part of the economy is in commercial real estate, and it's estimated there's about 2.5 trillion of commercial real estate debt or mortgages on big office buildings that mature or balloon over the next 5 years. And so that's significant. So that's a lot of dollars coming up for renewal, for refinancing in a much higher interest rate environment. Now, I'm going somewhere with this. I'm still talking about the banking crisis, but I want to tie in real estate and how this impacts it. Particularly, I'm talking commercial real estate right now. Goldman Sachs did a study showing that office building appraisals are down 25% in the last year. And of course, rents are continuing to fall on commercial office space. Now, one of the things when you look at mortgages and loans are what we call delinquency rates. And delinquency rates are up pretty significantly over just in the last 6 to 9 months. They're up from about 1.5% to almost 2.5%, which might sound like static, but that's a meaningful jump. And so, so let's tie this in. That's $6 trillion of commercial mortgages in the office space, commercial real estate world. Half of that is held by banks. Okay. So a lot of these banks that may have uninsured deposits are also holding a lot of this paper, these loans on commercial real estate. Now, there was another study done on this that of that, around 50% that's held in banks on this large part of the market, a large majority is held by, you guessed it, regional banks. So regional banks are some of the ones that have been in the news having problems with runs on the bank and kind of mismanagement by buying long-dated securities that on paper have losses. On paper, they're going to mature at par, but if they have to go sell them, that there's losses in the market. So this is another potentially huge problem, could be systemic for banks, and in particular regional banks, depending on how they're levered to it, depending on how they're managing this, that as defaults increase in the commercial office space. Now, this is just my opinion, but the Federal Reserve, the FDIC, the agencies that support consumers, they did step in to bail out the banks and protect consumers from losing their dollars in SVB and some of these others. But I think it's a little far-fetched that the Fed will jump in and protect the banks if commercial loans, office building mortgages start to default. I don't know that we'll see the same outcome there on that. So at some point, the free market system has to be allowed to work itself out. So that's a lot just on one point. But I do think part of the disconnect in the market, again, we're doing the economic market update here at the beginning of second quarter 2023. A lot of investors think the banking crisis is kind of a one and done deal. I think there's more that could be there. Again, just in summary, the commercial mortgages in the real estate world, the yield curve I talked a little bit about, and then just the fact that there's still a lot of banks that have meaningfully uninsured deposits. All right, so let me jump to point number 2. So point number 2 of why I think there's a disconnect in the market, stock and bonds market, mutual funds, 401ks, I think everyone's probably feeling pretty good. We do think there's going to be a lot of headwind as we go into the summer and the fall. We do think a recession is imminent. I'm going to talk a little bit more on that here at the end, but let's talk a little bit about point number 2, and that's the Federal Reserve. There's a growing sentiment that the Federal Reserve is going to stop raising interest rates, and the key word is pivot, that the Federal Reserve, led by Jerome Powell, is going to pivot and not only stop raising interest rates, but lower them. And I think that's a complete fallacy. And part of that is people just in their good nature want to believe, okay, that things are going to get better now. But the data supports something completely different. History shows that inflation, when you have conditions like we're in now, both in the U.S. and globally, that inflation can stay stubbornly high for 2, 3, 4, 5 years. It doesn't just immediately go away. Now, we live in an instant gratification society with social media and having our iPhones with us all the time, but this type of inflation doesn't just go away in overnight or in 3 months. Now, there's also the possibility, and we've talked about this before, of a double dip inflation, where historically, if you look at post-World War II, inflation went up went down, and then it went back up again before it settled back down to a normal level. So even that's still on the table. Right now, inflation is slowly ticking down, but it's nowhere near where the Federal Reserve has repeatedly said they want to get inflation. So just remember, interest rates, a lot of things are correlated to that, but one of them is the level of inflation. As many of you know, the Federal Reserve raised interest rates in March, a quarter of a percentage point, and now the federal rate is at 5%. And if you look at the different models that predict out where the interest rate policy for the United States will be looking into 2024, that model now shows that the federal rate will be 4.25. So 4.25. So it does show that it's going to be lower, but not meaningfully lower. And what we're looking at here is December of 2024. So the models are predicting that interest rates will be lower than they are today. But again, 5% down to 4.25, that's not that much lower, right? But so I think that's something that's a massive disconnect. I think a lot of institutions are thinking that the Fed will start lowering rates quicker. That'll kind of make the markets take off and consumer spending keep going up. Talked a little bit about inflation. The inflation data that came, it's called CPI, Consumer Price Index, excluding food and energy in February came in at 5.5%. And in January, it was 5.6. So inflation did come down a hair, a tenth of a percentage point. But what it tells me is that's a very meager decline. And it reinforces my thesis is that inflation is stubborn and it's not going away anytime soon. So the Federal Reserve has said publicly on many occasions that the nominal rate that they're targeting inflation to get it down to is, somewhere around 2 to 2.5%. So that's a long way to go, and that's another reason why we don't think interest rates are going down anytime soon. Now, in March, when the Federal Reserve met and they raised interest rates, they released what's called their minutes, their meeting minutes. And I just want to share a couple of points from this. And, really in this show, I'm really trying to give you some data and some market update. Again, we want to take this data and then be mindful as Kingdom investors on how do we protect our capital? How do we look for opportunities based on what's going on? Because even when data is bad or things are disjointed, there are opportunities if we know what to look for and if we know where to look. So the Federal Reserve in their meeting in March, they said that stocks and real estate prices are aggressively valued and they could plummet. And they acknowledge that painfully high inflation could easily persist well into 2024. Now, Chairman Powell has also publicly said that he expects to raise interest rates up to 2 more times in 2023. So they raised it in March. We're sitting at 5%. So we could easily see 1 to 2 more increases in interest rates. And along those same lines, they've communicated publicly that they do not plan to lower interest rates in 2023. So again, another reason why the markets and investors' thinking and sentiment are disjointed from kind of what's really going on in the economy, what's going on with policy. Well, let's jump to another point that I want to educate you on as we look at the economic market update, and that is corporate earnings. So publicly traded companies that report their earnings. There's a prevailing belief in the investor community and based on where the markets are that corporate earnings are somehow going to increase, that they're going to be going up, even though the economy is slowing down. And so there's this concept of financial gravity, right? So what goes up must come down. It's going to be very hard for corporations to increase their earnings when the economy is slowing down. So let me give you some facts on that. In the fourth quarter of 2022, corporate earnings decreased 4.7%. And for the first quarter of 2023, it's estimated that the S&P 500 that earnings will decrease somewhere around 6.5%. So that's the biggest decline since the start of the pandemic in April of 2020. Now, this is bad news for the economy and the stock market because you need to remember that in the long term, the stock market mirrors the directional trend of the economy. So as the economy goes, so goes the market. In particular, we're talking about the stock market right now. So declining earnings is what we saw in the fourth quarter. It's what we're expecting for the first quarter. That's a classic sign that demand for goods and services are starting to fall, right? Companies have lower earnings. It means consumers, small businesses are buying less goods and services. Now, most Wall Street analysts and many Fortune 500 CEOs, when interviewed over the last year, have fully said they expect a recession. And in fact, we've seen a lot of CEOs. We've covered this in some other places. Many CEOs are going through significant layoffs in preparation for a meaningful slowdown in the economy and a recession. So if you look at big tech companies, big banks across the board, a lot of companies are trying to get ahead of this because they see the writing on the wall here, and that is something as individual investors we need to be mindful of. Now let's talk a little bit about the markets. We get the question quite often of, well, is the stock market going to crash? Is the real estate market going to crash? Things of that nature. Again, no one knows, and no one rings a bell to tell you when to get out of the water. No one rings a bell to tell you when to get in. Investing, no matter what it's in, whether it's in stocks or gold or real estate, is a behavioral process. And so we have to balance, and we have to use a kingdom perspective to balance the emotions of greed and fear. And that's what makes a savvy investor. And what makes a kingdom investor is you take these types of information sources and you research it, you pray through it, and you get clarity on, well, where are the asset classes that I can protect myself while the storm blows through? And then what are going to be the types of assets that once the storm blows through, once there is an economic reset in some areas, that I would want to go shopping? You know, when things are on sale and you're buying it as a consumer, that's when most people want to buy. Hey, you know, this particular pair of shoes, you know, they just marked it off 30%. I want to buy it. Now, an investor, the mindset of a savvy investor is one where investments that you understand and that you want to own long term, when they are on sale for 20, 30, 40% what they once were, that is your time to buy. So when we think about the markets, the stock market is certainly a predictive indicator. These bottoming processes take time. So the S&P 500, you know, currently here, early April, mid-April 2023, is somewhere around 4,000 to 4,100. Again, that fluctuates every day that the markets are open. And the market's about 15 to 17% lower than the all-time highs. Now, my personal opinion would be we really need to see a market correction to get the S&P 500 somewhere between 3,000 and 3,300. Now, again, that is merely my personal opinion. I don't know the timing of that. I think a lot of these headwinds are starting to build up. I think investor sentiment, investor outlook is a little too bullish. It's a little too rosy based on the data we're seeing, based on what's going on with banks and interest rates. So again, as you're thinking about real estate, stock market, asset investing, you want to have a strategy. You want to have an overall plan. You don't want to be overweighted into any one asset. Again, you want to work through what your risk tolerance is, what your time horizon is, what is your long-term strategy, not only for how to protect your money and grow it, but how to use your money to make a kingdom impact. It's been a pretty wild ride over the last 3 years since the pandemic. We've probably seen more significant economic events in the last 3 years than we've seen in the prior 15 to 20 years. So, again, that does drive people in their thinking. And, whether it's been what's happened with cryptocurrencies or what's happened with the Federal Reserve, what's happening in Russia and Ukraine and China, there's just a lot of things going on right now. But I want to encourage you, when we look at this through the lens of we are managers of resources that God has given us, and we do live in Babylon, but we have these skills, the gifts, and even other advisors around us to help us interpret how do we make wise choices for our family, for our business, for our church, for our community, for the glory of God. So I do think we'll see a recession. I don't think it's something that we need to be fearful of, just as we wrap up here with the economic market update. I do think as we walk into that, we want to be mindful of how much risk we're taking in our investments. Again, just a general observation on that. There's a lot of potential landmines that are out there right now. And so I want to encourage you. I know we covered a lot of data and stats on the market outlook, but I hope it helps give you some perspective on where we are as an economy. What are some of the key factors that we look at? And let's just recognize the fact that even in the midst of economic shaking, economic chaos, the kingdom investor stands knowing that we can be given, right? If we don't walk in fear, we can be given strategies for how to protect wealth, how to help people protect wealth, and how to grow it with wise strategies. So again, that's our outlook. I think realistically, as this earnings season starts, I think we're going to see earnings down, and that really is what we would call an earnings recession for corporate America. I think we'll continue to see some issues with the banking community and what's going on there. I think inflation is here for the foreseeable future. I do not see the Fed lowering rates anytime soon. In fact, we would expect a couple of more rate hikes. So buckle up. I want to encourage you, just evaluate your financial plan. If you want to just an independent assessment on how you're set up with your resources, feel free to reach out to us directly. We'll be happy to help you. You can connect with us at wealthbuilders.net. And then we do have some free resources that you can download at wealthbuilders.net/invest. And I'll be happy to send you this bank list as well of some of the major banks in the U.S. that are carrying heavily uninsured deposits on that. So again, happy to help if you have questions. And again, we want to be mindful. I think it's very likely we'll see a formal recession by the time we get to the fall. The government may choose to change the definition of a recession. But again, a recession is just a slowing down of earnings and a slowing down of the growth in the economy over 2 consecutive quarters or longer. So I think we're on the precipice of that. So I do think asset prices are going to see more volatility, and so you don't want to just stick your head in the sand and hope that things. Hope is not a strategy. You want to have some well thought out wisdom on why you do what you do with your money and with your business. So again, we'll cover more economic market update next quarter. But again, there's a lot of good investment opportunities out there. We just need to understand how they relate to what's going on with the Federal Reserve, the banking system, what's going on globally with Russia and China and some of the other countries. Well, hey, this has been fun. I hope you found this informative, and pray that it gives you wisdom and clarity for managing your businesses and your investment assets. That's all for today. To find us, you can reach us at wealthbuilders.net, and we will see you next time on the Kingdom Finance Show. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.